All right, good morning, everybody. It's FOMC day. So normally when we focus on an FOMC week, we have the expectation that price really isn't going to do all that much. And so far this week, we've continued to expand from 4,300, which is where we ended the week on Friday, to being at 44.25. There is this expectation of buy the rumor, sell the news. And the bad thing about that kind of approach is you just kind of got to take it on faith. And that's not a really good way to trade, right? It's like trading on hope. It's a really bad idea. But I am going to continue to stress caution that we've had this bias of buy the rumor, sell the news for this FOMC event now for weeks and weeks and weeks. And we're finally here. So if it's true, then we're very likely going to see a sell-off. You know, it's not like I'm suggesting we're going to go down to 3,500 or something like that. But I would say that we could have a sell-off that takes us back down to around 4,000, and not in a day either, right? We're not talking about making the move in a single day, but getting back to 43 would be a given. And then getting back inside that range all the way down and into 4,000 wouldn't be out of line. That's not my base case argument. I don't think we're going to have that kind of sell-off. Markets don't move in a straight line, so having some sort of a pullback, maybe to 44, back to 43.50. There's a lot of analysts who are calling for 45 and 46 by the end of the year. I don't think that's reaching too far either. I guess I'm just trying to say don't be complacent with these longs. We are seeing breadth expand across the marketplace, right? More and more names are back above their 20, back above their 50, back above their 200. And while the first half of this year was basically carried by the FANG names, we're now seeing the rest of the market rise up in that higher tide. So I guess we're just back to waiting on the news. It is interesting though that we didn't pause for the week, right? Like a normal expectation is the market's just going to hold its breath and wait for the FOMC announcement. And that is certainly not what we got. So we do have PPI today. We had CPI yesterday, PPI today, and then we've got the FOMC. We'll first get the data at 2 o'clock. Then we'll get a press conference at 2:30 with Powell. Yesterday, I talked about a gap close concept from CPI. Now, technically, we have the same kind of thing for PPI, technically, right? I mean, the opportunity is there, but if you go back and look, we haven't really had very many times where it played out. Yesterday, I've got to say that the move we were looking for, we certainly didn't get. So just to kind of show what this looks like, before we get into the news of the day. This is yesterday's CPI, and you can see this wishy-washy sideways 5-minute candle where we went both directions and basically closed right where we started. And I had mentioned that that's not what we want, right? We want something that looks, say, like this. This is April's CPI, I believe. And with April's CPI, it's a perfect example of what we want, a single bar push, a single direction where it tops out and then it spends the rest of the morning, maybe even into the afternoon, coming back down to close that gap. So I had two examples yesterday, March, which looked like this, and April, which looked like this, or May. May had the same thing, a really great opportunity, great setup. This is what we want. This is what we do not want. This is what we do not want, right? We don't want this. Now, it's not to say that this isn't tradable. By all means, you got an opportunity, take it. But if you're trying to play the gap close, it's supposed to look like this, and then you play the gap close. When it looks like this, you're not doing a gap close play. Because look at where that 5-minute candle closed at the 8:30 event. Price ran in both directions and it came right back down, and price closed very close to where the price opened. What gap? I didn't see no gap. There's no gap. And in fact, in the very next candle, it did go down and close the gap. Same thing here. This one, on the other hand, opened here, ran all the way up and closed here. Now I have a gap that needs to be filled, and we spend the rest of the morning getting that gap closed right there. Yeah? Yeah, you like it. So with PPI on deck today, we do have the potential for a candle that looks like this. And it doesn't have to be an upward pointing candle. It can be a downward pointing candle too, right? So it just needs to be this big, massive thrusting candle, engulfing candle, expansion candle. I've heard a lot of different names for it. You can call it Bob's uncle if you want to. I don't care what you call it. That's what it looks like. All right. So PPI day, CPI, non-farm payrolls. That's another one that has offered some amazing gap close plays. There's plenty of them out there. Kind of take your pick. We have crude inventories today. It's been over the news quite a bit. 3 years ago, everybody just kind of poo-pooed on the idea that energy was ever going to really be impactful, because it had just for so long had such a reduced market cap that it didn't have any weight left in the market. We really just kind of blew it off, like whatever, energy's up, energy's down, it's not going to really push us around. But things have changed, and eventually energy is going to go back to being this minor market cap that doesn't really drive the markets or push us around. But that's not where we're at right now. So when energy moves, you want to pay attention to it. Everybody's really focused on interest and the cost of making things, inflation, and a lot of that starts with how much energy costs. So these energy numbers that come out today are important. They've been important for the last year or so, and they're going to continue to be important. So is any news coming out of OPEC or the United States Strategic Petroleum Reserve, and how much of that they have on reserve, how much they're letting go, or how much they're beginning to stockpile again. So those numbers at 10:30, they offer insight into what's going on into the rest of the world, but they also offer a little bit of insight of what could happen during our trading day. If you want to play in the energy market, but you don't want to trade the oil futures, which are $1,000 per point. Yeah, it's a little uncomfortable. Then there is a micro, or you could use something like USO. It shouldn't be a surprise that energy and steel often correlate. I've worked on drilling rigs for most of my life, but I also worked in the steel industry for a while. And they're more closely related than we'd like to believe. So, another way to also approach that is through things like X Steel and others. X Steel used to be a lot more fun when it was cheaper. It's still fun. It's just not as cheap. Very liquid, great options. We're not expecting any surprises. The Fed is not into the gotcha business. They telegraph in advance what their intentions are so that they do not surprise the market. They don't want to surprise the market. And they continue to strive towards better communication so that they can get the market to believe the words that they're saying. Although we all have to try to realize that the Fed knows what's going to happen if they say we're going to pause. That word pause has historical weight behind it. So they try to get sneaky, right? And they try to sidestep that word by using this skip language. It equates to the same thing, right? That they're not going to raise rates, but they're not going to cut. They're going to hold here and see what's going on. So whether they call it a skip or a cut or a hamburger, it doesn't matter what they call it. If they don't raise rates and they don't cut rates, then they've paused in their hiking regime. We use FX Street with this impact gauge to try to identify potential economic events that have a history of moving the market. And as you can see at 2 o'clock into the rest of the day at 2:30, and then even tonight, we're on high alert for anticipated impact or volatility. Someone asked me yesterday why I was warning against putting positions on in front of this FOMC event. And they said, I keep hearing that today's not really supposed to be that big of a deal, that it's pretty much going to be a nothing burger, really. There's just nothing to it. And he's right, that everything that I've looked around and heard over the last 2 weeks, 3 weeks has been a lot of analysts and researchers suggesting that this FOMC really isn't expected to be a big thing, which is exactly why I'm cautious, right? If everybody thinks it's going to be a big move, they will hedge the hell out of it. And then we very often just don't get that big move, right? Because what causes big moves? People change their position. If they're heavily long, they dump it. If they're heavily short, they buy it back, right? They're surprised and they're shook and they react and respond quickly, and the markets move fast. So if they're hedged to the eyeballs, then they're not caught off sides. They're not worried. They're not dumping their positions. The market doesn't make big moves. Well, everybody seems to think this FOMC is just going to be laissez-faire. It's all just that. It's just another day. Don't worry about it. We're going to see a little volatility, but it'll settle back down and Bob's your uncle. Yeah, well, maybe. Probably, most likely, that's going to be it. But being a contrarian, just be cautious, because I'm a little concerned about the lack of hedging. All right, we still have the market maker move. We have an average ADR of about 1%, and we have a market maker move of 1.3%. Add those two together, 43 here and 50 here, we get $93. We can even round up and just say an even $100 move from our current location. It comes up to about a 2.3% move, right? I like to use percentages, but dollars, percent, it really, either way you want to go, right? And as you can see, we got a lot of things on the books. Machinery orders tonight, those are around the world. Kind of just cut those down a little bit. 8:30, 10, 10:30, 2, and 2:30. Now the business inflation expectations normally is not going to be that bad, other than obviously inflation is going to be in there. If that was our standalone thing, it'd probably be worth taking a look at. But tucking that in there with a PPI day and then with an FOMC announcement, it's very likely not going to hold much weight today, and maybe is something that people look at over the weekend more, kind of parse through the data and look at it in greater detail. So I would say the big driver today is going to be 8:30 and then 10:30 and then 2 and then 2:30. Remember that the machines are going to read the 2 o'clock report and they'll make a move. And then Powell's going to come out and talk, and the machines are going to be parsing his language, looking for key phrases and certain words, which is why we get sometimes the drive to the upside during Powell's speech, and then he'll say something and it'll drop really hard. And then 10 minutes later, he'll say something else and it'll rally back up again. It's the machines playing on his words because the machine has been told what words to pay attention to or what series of phrases to watch for. Volume is a little light, but that's expected on a day like this. It should be light because of PPI. It should be light because of CPI. And remember yesterday, we were actually heavier than I thought we should be. Normally, when we come into a CPI or a PPI, we're in the 80s or even the 70s. And yesterday we were sitting in the 100 zone. Something to consider, right? So this does its job. It would just warn us if volume was light and we didn't have a reason for it to be light, then we'd want to go looking for it. It would just get that out of the way and take back some real estate on this chart. We have an MDP. That's a missed daily pivot. If we break our own Globex low, we're very likely going to go to that pivot point, and that would be the target I'd aim for. Below that, the cash open at 4,400. Basically, it was 4,402, which happened to also be the Globex high or really close to it, right? So that pivot point is going to be a pretty strong pivot point. Step by step, target by target, it would be the close of yesterday, the Globex open, the Globex low. There's a voodoo line and a cog line at 4411. Then the daily pivot, which would end the MDP. RTH cash open. And then the RTH low of yesterday, which happens to line up with another voodoo line. Look at that tag. I mean, it wasn't spot on perfect, but yeah, that's pretty darn close. Then the ADR half below that. Like falling out of a tree and hitting each branch on the way down. For an upside push, we got 44.35, which is a voodoo line, much bigger than these lighter green ones. ADR half, and then a voodoo line at 44.50, which happens to also be an options area, 44.50. Oh, I'm not running the newer one. All right, well, we can solve that. Let's just check the spot gamma levels. $44.47. It's a call wall. 44.20, 44.47, and then 44.99. We just round that up to 4,500. With the additional market maker move attached to today's potential move, the ADR says that we could go to 44.60. The market maker move says we could take another 1% above that, 1.14. That would get us to 45.11 today. That's not extended, right? That's just what is on the books as a measurement for today. If we were to get wild, we could easily double that number. No problem. So 45.11, really close to a voodoo line at 45.14. And for the downside, adding another 1.14 to that would get us down to 43.24, basically 43.25. The previous week's high would be the target, 43.25. So now we got our upside downside measures when we take market maker move and we add it to the ADR and we plot it in both directions. We got our plus or minus. All of that being a controlled move, not something that got out of line and really got exaggerated. $10-day, 30-minute volume profile. We are still a considerable distance from the point of control. And we have this really nice air pocket below us. There's some minor pivots on the way back down, but it's really shallow here. So the expectation would be that we could get back to 43.50 relatively easy. Right? Easy is not necessarily a word that I like to use, but there's not much in the way to slow us down, right? Just remember, we've been hitting something, or a correlated market has been hitting something like we had the other day here, right? With that low. We don't have a VPOC from yesterday because we've hit it in the overnight hours. But if we had carried the point of control from yesterday into today's session, you could see how price interacted with that level. Now, the thing about these volume profiles, I've had someone reach out on this. I only carry forward the point of control that has not been hit yet, right? That VPOC. It doesn't mean that the others aren't worth carrying over. And if you were to study volume profile, you would find that a lot of analysts do carry forward the volume profile from yesterday into today. There's nothing wrong with that. It's just not what I do. It's not my style. I've got enough pivot points, right? I don't need another one. So I only focus on the ones that have not yet been hit, and I keep them around until we finally hit, right? See, we got these old ones from way down here that still have not been triggered. And, just stack them up like cordwood, keep them in the corner. There's more than one way to skin this cat. There's no wrong way to do it. But the main thing you want to focus on is consistency, right? So if you always carry forward your lines, then do that. And if you only do the VPOCs, then do that. But don't mix and match, right? Here's another example of the market hitting something. This is a shallow zone, is very, very clear, classic B shape. And yet we hit something. Or a correlated market hit something. Because that should have dropped right back down through this zone just as easily as it ran up through that zone. And it didn't. I don't know what to do with it. Just seen it and wanted to point it out. All right, we are 4.3% above the 10-week. That's getting a little bit up there. When I built this indicator, the idea was that we wanted to look and be able to answer a question. Have we moved too far, too fast, and are we due for a pullback? Now, I'm going to drag this across enough to hide COVID, because I really think COVID screwed the numbers up a little bit. So we're past COVID here. And now we're looking at things from all the way back to 2020, right? From June of 2020. That yellow line is really close to where we are right now. And you can count on one hand, even my hand with missing fingers, how many times we've been higher than that. Not very many times. This one back here is that August 2022 when we hit the 200 period moving average and the entire market dropped back, right? That awesome rally that we had. And then right after that, the mic drop moment from Jackson Hole, where Powell told the market to suck it up. Set a peak not long after we got extended above the 10 here. And we got above the 10 here, and we didn't set a peak for nearly a month after that, right? So this seemed to be maybe another week. That seems nearly a market month before we rolled over. So we have moved really far, really fast. We are getting extended past that 10. We're getting into an area where we're so far away from the 10 that we have to have this expectation that the market's going to pause and let the 10 get caught up, or it's going to turn around and drive back towards the 10 to close the gap, right? Mean reversion, basically. In this one, we had one more blow off, right? One more week where we expanded it even higher before it all started to unwind and sell off hard. Like a blow off top or a capitulation. And here we just went sideways, right? When we got above it this time back here, it had a little bit more up, but it was a lot of sideways, letting that 10 get caught back up again. It didn't pause, slow down, or stop at all on this one. It just kept right on going. And on this one, we had another blow off top. So another big move higher first, and then a dump. So with CPI on deck, excuse me, PPI on deck, and FOMC on deck, and having now made it to this exaggerated distance from the 10, you got to kind of have this sneaky suspicion that we're going to get a little bit more, right? A little blow off top kind of scenario. Come on, darn you. There it is. Before we turn around and come back. And I'm not talking about, dumping down, right? Just a good size pullback, a healthy, clean pullback. We are outside of the weekly expected move. 4202 is the top of that range. We should close inside of this range 80% of the time. So when we get out of it, it matters. No, I didn't misspeak. The one standard deviation would be 69 point blah, blah, blah. All right. We always just round up and say 70%. And that's a normal market. This isn't a normal market. This is the S&P. It's literally the reason that this indicator was built, right? It was for the SPX. We just stole it and used it on everything else like the ES. Statistically speaking, the S&P closes inside of the box more than anything else, more than it statistically should. So while a one standard deviation implies it should do it 70% of the time, the S&P actually does it more than 80% of the time. So I didn't misspeak. You're right. 70% is the one standard deviation. Good question, no? Nerding out on me at 7 o'clock in the morning. All right, we can do that. So we've been evaluating the 10-week. We want to get a little bit closer and look at the 10-day. So here, we've not yet gotten into the extreme. We haven't moved too far, too fast on this lower time frame of just being a daily. We could easily expand another 1% away from the 10-day, and we would still not consider it extreme, but we would consider it starting to get into an overbought scenario at that point. All right, so we're not there, but we're getting close to having that conversation. Since we know that we have FOMC and PPI, trying to evaluate the equities really is kind of like just spinning your wheels in the mud, right? It's not going to do much for us. But that doesn't mean there isn't any work that we could do. Right now, we're looking at the VIX. I want to try to just look around, are we in contango or are we in backwardation? Now we're in contango, everything is fine here, but we wouldn't have known unless we looked, right? So we stop by here, we check, make sure nothing's out of line. We can take a look at something like the VVIX. kind of got to get all this stuff out of the way. So, we're not sitting down in these lows, but we did come off of that support level relatively well, the low 80s. All right, US dollar Japan. Looked like they did a pretty decent job of defending this yesterday. Nice, strong rally off of that low. Made it all the way back up to the top of the range. And now this morning is weak again. So after such a strong drive yesterday, I'd be looking for a topside breakout on that 140.30 and see if it's going to make another run towards that 141. If it does begin to make that run for the 141, it's very likely going to happen fast, right? It's going to look a lot like this back here, this big expansion candle. And I know after the move we had yesterday with that recovery, it's hard to believe that we could get another big move like that 2 days in a row. But we can see back here, not very long ago either, where we had 2 really big days back to back, or even here where we had 3 days in a row where we made some pretty good sweeping moves. So when this thing goes, it can really, really go. We've been range bound inside of this trash for a while. The longer we stay range bound, the more compressed we get. So the potential for a big move is there. And I'm looking upwards, but honestly, it doesn't have to, right? It could go to the downside just as easily. Bonds are still sideways. The recovery from yesterday with that doji candle just didn't do it any justice. I guess that was the 12th, right? Not yesterday. That didn't do us any good. Sold off yesterday. Really need to see how it's going to follow through today. It's up slightly this morning. Bonds are, but not enough, right? So we're still just chopping around in the box here. We need to get out of the box. We just got to get going, right? And until we do, we don't have anything. Get that evening star reversal and the move back down, and now we're just in the middle of nothing. TNX, on the other hand, is much closer to resolving this box. Right, so you have the morning star reversal and the run back up, and it's nearing the top of that range. So this one bottomed out, this one topped out, came down and found support. This one came up and hit resistance. In the pullback on the right, where it was moving towards $100, it should be a lot closer to that $100 mark for the breakdown. Just like this is much closer to this high here, this resistance, and ready to break out. So the TNX is the driver here, not the TLT. This one's moving and it's affecting this one. If it was the other way around, then the bonds would be closer to the breakout and the TNX would be the one dragging its feet. Now I say that, but you have to be aware that the market, we're looking at these things on Thinkorswim, and Thinkorswim doesn't show the intra market on the daily until after 9:30. So just something to keep in mind. Tesla got a little closer to that gap close. 264. What's it going to be? excuse me, 265.25. So we got a little bit closer to that yesterday. This morning we're at 263.45. So there's one for you. Even though we had already talked about the fact that we might not see, or it might not do as much good to analyze the overall broader market because of the FOMC and blah, blah, blah. But this is going to hit that gap. I'm really confident about that. So having said that, I've been wrong before. I will absolutely be wrong again, but I think we're going to close that gap. And after we close that gap, I think this thing is going to sell off. Now, the good thing is we don't have to assume, we don't have to guess, right? And nobody cares what I think. Nobody cares what you think either when it comes to trading. That's a mantra I used to say to people constantly. Seems like I don't say it too much anymore, but don't trade what you think, trade what you have, trade what you know, trade what you see. With that in mind, think about where the gap is going to be, right? So we closed at 258.71. The high of yesterday was 259.68. We'll call it 259.71 just for the same language. So a $1 move. And now this morning in the pre-market, we're sitting very close to 265.25. We're going to want to see a breakdown back inside the 259. That could be a trigger for your short, or at least the place to set your alert. That goes off first, gets your attention. You come in, you start aiming for a short play. And once it gets below the close, which was that 258.71, then that could be your place to get in. I know that's a long wait, watching it fall, you know, what, $6 before even considering to get in. But I'm talking about a swing trade, right? Not just some intraday hourly trade. Because if you're going for that, there would be no reason to wait, right? You'd want to respond to price as soon as possible. But for a solid swing to short this sucker, you're going to want to make sure you're not shorting something like this and something like this, right? Those swing traders, short swing traders, are not comfortable, right? They're losing. So you kind of want enough information on this short that you can avoid that at least a little bit, right? There's no guarantee. So you want at least back inside of yesterday's candle. If you want to have more confirmation than that, you would want a weekly close below 252.42. That would actually turn this current week red, which, you know, right now is green. So if we can close on the week below that level, then it would be a gapped up sell-off, right? And the following week would start to get us into an evening star reversal from this move up and then the rollover. And that would be 1, 2, 3, 4, 5th week. The 5-bar rule. So something to consider. What makes more sense though is that we close this week green, and then we gap down next week and we can start to make the move back. So if you're looking for, you know, a good solid short here, a weekly close below that. You can start with getting inside this, so 252, or the close of it at 244. I like getting inside of it at 252. That'd be a nice LRE, low risk entry. Yeah. We're not even going to do it because it's just spinning wheels, right? So everybody be careful, be safe, watch the clock, keep your eye on the bonds and the yields, and just remember on this FOMC, you don't have to trade, right? You can just sit back, watch the show, live to fight another day, keep your account safe, right? Normally, we don't have anything worth trading on Monday and Tuesday, and we certainly did this week, right? We had some great opportunities to trade yesterday and on Monday. So I don't want to say that you won't get some opportunities before 2 o'clock, because I don't think that's true. Just just be careful. It's likely to be a little difficult to play today, and I'll see you all tomorrow.